A fall in jobless claims may ease fears of a US recession. Welcome to Market Insight, I'm Thomas Warner. US government figures out a short while ago showed initial jobless claims fell back from last week's 11-month high. The data may help soothe fears that the world's biggest economy is cooling quicker than expected. Meanwhile, Chinese inflation figures due overnight should give investors a sense of just how cool the world's second biggest economy is at the moment. With me to tell us what it all means, particularly for Europe, is Tim Graf, Head of Macro Strategy for EMEA at State Street Global Markets. Tim, a very warm welcome to you. Let's start with those initial jobless claims. It was employment data last Friday that started a Wall Street sell-off with that low non-farm payrolls reading. What do these latest numbers tell us?
I think it gives you the sense that maybe things aren't quite as bad as the last week's data might have seemed. There was the expectation that jobless claims would fall because last week's numbers were skewed up a little bit by some of the weather effects that also seem to have found their way into Friday's payroll report. So we did expect them to drop, but we didn't quite expect them to drop this much, which is good news. It should help risk recover a little bit more. US rates, which had fallen quite precipitously on the prospect of a harder US landing, do have a sense of perhaps moving a little bit higher as we close the week out, and again reversing some of that flight to quality trade from late last week and early this week. So all in all, a sign that the jobs market is probably slowing, but not nearly as much as was originally feared.
And Tim, this must really put an end to talk of an emergency between meeting cut from the Fed, I would have thought.
Yeah, I think that was always very, very fanciful. The notion that the Fed would respond to what was largely a big position unwind and a lot of levered carry trades was always a little bit fanciful. I think there wasn't really the pressing economic need to do so. There certainly is now a higher probability that the US is slowing a little bit faster, but I don't think it's of a scale that would get the Fed off the sidelines. They've got plenty of time to message what they want to do in September. It's pretty clear they're going to cut. The question now is whether they endorse the market pricing for 50 basis points. I suspect they will. The Fed tends not to surprise the market. And they've got now 6 weeks or so to really prep for that.
Well, let's turn to China now, Tim. And consumer prices are seen rising for a sixth straight month, albeit very narrowly. We know Beijing has been at pains to get people spending again. How do you rate their progress?
It's pretty slow. And to be honest, I don't think it's going to pick up anytime soon, because to really get consumer demand to be the driver of growth requires massive structural changes in China. And those will come, but we're talking about years, perhaps decades, for that rebalancing away from trade and investment-driven growth towards consumer demand-driven growth, a la what you see more in the US and, say, UK. That takes a long time. And I think there's a long-term willingness to pursue that type of growth strategy, but there's not the ability or willingness to do that overnight. So with this inflation data, I suspect it's going to continue to show that the consumer is still probably struggling a bit. A lot of bad news for China is in the price, but I don't think we're going to see really good news on the demand side for a lot longer.
We've highlighted China's reliance on trade, and we saw today that the US surpassed China as Germany's #1 trade partner this year. Yeah. We know that low demand from China has forced a lot of European companies to start rethinking their reliance on the country. Do you expect that trend to continue?
I think it's probably likely in the very short term, because I think that the Chinese domestic demand story is not likely to rebound anytime soon. And Europe is going to bear the brunt of that. They really didn't have a diverse set of trade partners when it comes to their main exports. And Chinese demand was a huge source of growth for Europe in the past couple of decades. And that now, as we alluded to before, is, you can't really count on that as strongly. And so I do think this is not going to be a trend that reverses anytime soon. It probably will eventually. China is, after all, a fast-growing economy, or in theory it is. And if it does return to previous periods of strong growth, it should probably be Europe's largest trading partner just by virtue of its size. But I think for the near term, we're probably not going to see anything too different.
So where does that leave Europe, Tim?
I think they're still a little bit stuck. I mean, Europe has, again, in previous decades, relied on external demand, primarily Chinese demand, for one of its main sources of growth. And it's relied on energy sources from Russia to fuel a lot of that growth. And both of those channels are really impaired right now. I think different European countries deal with that very differently. Germany has probably been proven to be the most exposed to those two twin threats, where other countries, say France, are maybe a little bit less exposed because they have other sources of energy they can rely on, particularly nuclear power. So there's differentiation within it. It's not an entirely bad story. I think it's a country by country story, but when your largest economy within the economic bloc is subject to those two twin threats, it does make for a pretty cloudy and lackluster growth outlook, I would say.
And just finally, Tim, it must be a bit of a relief for European markets that there aren't more signs that the US is going to be entering a recession, because that really is the last thing Europe needs at the moment, isn't it?
Yeah, I would say so. I think that's really what's kind of stood out throughout all of the volatility of the last week, is that Europe has become kind of a sideshow, and really there's not too much differentiation between the European growth story and the global growth story, and it's about US assets, it's about US policy, and Europe kind of piggybacks off of that, I think, to a degree, and the market's perception of it goes up and down with the perception of those variables. And so better news for the US is probably better news for the world, and Europe as a large exporting economy to the world, benefits from that, I think, if there is better news in the US.
Tim Graf, Head of Macro Strategy for EMEA at State Street Global Markets. Many thanks for your thoughts today. And that is Market Insight. Don't forget you can watch more videos on Reuters.com.